Dear friends, today I will discuss on financial ratios. There are five types of financial ratios. First one, profitability ratios. Second, liquidity ratios. Third, management efficiency ratios. Fourth one, leverage ratios. And fifth one, valuation ratios. So today I will discuss on profitability ratios and why you used profitability ratios and their analysis. So profitability ratios are used to evaluate the company's ability to generate income as compared to its expenses and other costs during a particular time period. Also, these ratios are used to convey how well the company is able to perform in terms of generating profits. Profitability ratios are the most popular ratios used in fundamental analysis of securities. So some of the commonly used profitability ratios are gross profit margin, EBITDA margin, PAT margin, return on equity, return on capital employed, return on assets. So let's discuss all these six profitability ratios one by one. First, gross profit margin. It is a measurement of company's gross profit as a percentage to its net sales. Gross profit margin mathematical formula is gross profit by net sales, where gross profit equal to net sales minus cost of goods sold. The financial ratio tells about the company's profitability at gross level. It tells about the efficiency of the company in using its raw material, labor, and manufacturing related expenses to generate profit. So only calculating gross profit margin cannot help you to analyze a company. You must have to compare the gross profit margin of competitors, companies of same sector. How to analyze gross profit margin? You have to check the gross profit margin of last few years and see whether it is on an increasing trend or in an decreasing trend. So second one, EBITDA margin. EBITDA means earning before interest, tax, depreciation and amortization. It is a measurement of company's earning before interest, tax, depreciation and amortization as a percentage of its net sales. Mathematical formula of EBITDA margin equal to EBITDA by net sales. This financial ratio tells about the company's profitability at the operating level. So it is also called the operating margin. EBITDA margin tells about the efficiency of the management and operational efficiency of the company. So how to analyze the EBITDA margin? Just calculating EBITDA margin cannot help you to analyze a company. You have to compare EBITDA margin of competitors and also check EBITDA margin of last few years and see whether it is on an increasing trend or in a decreasing trend. Third one, PAT margin. PAT margin is a measurement of company's net profit as a percentage of its net sales. Mathematical formula of PAT margin equal to PAT by net sales. PAT means profit after tax. This financial ratio calculated the profitability at the profitability level, taking into account all the expenses including interest cost, depreciation and tax. So fourth one is return on equity. Return on equity measures how much profit a company generates with the money that shareholders have invested. It is also known as the return on net worth. Mathematical formula of ROE equal to net profit divided by average shareholders equity into 100, where average shareholders equity is shareholders at beginning plus shareholders at the end divided by 2. So how to analyze return on equity? Higher the return on equity, the better it is for the shareholders. Normally, ROE over 18% is better preferable. So it tells the shareholders how effectively their money is being used. Then fifth one, return on capital employed. It measures how much profit a company generates with its capital employed. Here, the total capital employed includes both equity and debt. Debt in short term and long term. As we consider debt into consideration, so return on capital employed overcome a major weakness of return on equity. Then the last one, return on assets. It measures how much profit a company generates using its total assets. Mathematical formula of return on assets equal to net income plus interest into 1 minus tax rate whole divided by total average assets. So how to analyze return on assets? Higher the return on assets, the better it is for the shareholders. It tells the shareholders about how efficient a company's management is at using its asset to generate income. ROA reflects capital intensity of a company. So normally return on asset over 5% is considered most respectable. So these are all about profitability ratios. So friends, please